Yo, what's going on, believers? Happy Sunday. I'm going to do my typical weekly outlook now. Going to skip the review, not going to really even look at the economic calendar this time. For this whole month, every video I've produced have really highlighted two main events. One happened the week before last, which was CPI, and the next one is actually happening this week. That's the federal funds rate. So I've been mentioning those since the month first began, actually since before the month began, and so I don't see the reason to really hammer home anymore on that. Just gonna dive right into the charts here. Mostly going to be focused on the daily and weekly interval, and just want to go over a couple of things, talk about some levels, some thoughts, and really thinking this will probably be one of my better videos. But from now until the time that I press stop recording, just see how that plays out. But so initially, first thing I want to talk about is liquidity, and you've heard me mention that before. Want to really, like I said, hammer home on some main points. Try to keep this really relatable, understandable. So liquidity, right? When I think of liquidity in terms of liquidity in the marketplace, all I'm thinking about is money transactions. That's it, right? From a viewpoint of if any market, liquidity is the exchange of money for some product or service. And so in these markets, essentially that product and or service is the opportunity to make money. And so that's what inspires liquidity to be brought into these marketplaces is this idea that money can be made using my money, right? There's no dollar per hour as far as this is concerned, right? There is no any other way to get paid here without risking money. Long story short, right? And so the liquidity here is transactions that are seeking to multiply themselves in some sense. And so hopefully that makes liquidity understandable a little bit more, right? It's simply just transactions. And so, why is that important? So, for example, as far as the three types of analysis, right, I've mentioned in one of my past videos, technical analysis is where I've been spending most of my time focused, right? And so, with technical analysis, that's simply just me looking at price charts utilizing time, which is this axis down here, the x-axis, and then y, which is price, right? Using time and price of the past to predict like at what time price will do certain things in the future, or try to time it. But that's the hardest part for sure. By like my account of the types of analysis and any of the things that are hardest to really get a grasp on, it's definitely time. Knowing when something's going to happen, that's damn near impossible in my opinion. But through dedicated, locked in, focused time, energy, and effort, right, spent trying to get some sort of edge as far as that's concerned, I do think it's possible. I definitely think it's possible. Shout out to ICT for even inspiring me to believe that that's is something that's possible, right? Um, but yeah, so as far as those transactions are concerned, right? For example, so there are different ways that people internalize the market movements, different ways that people have been taught it and such. So one example is as price dropped right on the dollar down here, and again, just for a second here, ignore the drawings that I have, right? Let me just hide that. Ignore the drawings I have for now, okay? But this down here, as there were large body candles dropping lower, and then it starts to move sideways here with an unwillingness, right, to go and take out this low, and then it starts to push his way back into the range, right, from this drop. So there are people that could look at this area and say that there was a area of demand down here, essentially just mean that there were buyers waiting down here, and once price was delivered to the level they wanted to get in at, then it started to run higher because of the buying pressure, right? Or also could be looking at this as like, okay, there was a lot of selling pressure, a lot of people selling, and then they started taking profits, right? So they're getting out of their sales, and that's why the market then is able to run higher back into the range that it created, run lower. And then another one is also pretty much along those same lines, but then just looking at it from a sense of, okay, there was a lot of selling pressure, and then all of a sudden it got down to a point where sellers were maybe starting to be worried that they might be overtaken by buyers. So then in a sense that's what happens, right? Is that there was some reason down here where there were a lot of buyers, and then so the buyers would then take over control of the marketplace here. And so my question to all three of those types of thought processes is simply, all right, then what happens next and why? And typically there aren't many answers that made sense with that follow-up question. So I'll leave that to your own study to really determine what thought process makes the most sense to you, right? Because again, everybody's different. There's no one way to skin this cat. But just in terms of liquidity, in a sense, that would also mean that down here, whatever was down here, right? The there was liquidity here. That's what how I'm right. I'm stripping away everything from those last three examples I just gave, and simply just going with, okay, there must have been some sort of liquidity down here. The market repriced to that liquidity, right? Was able to accumulate, and then starts to move away from that liquidity, because what does that do? Well, number one, anybody that was in a sell here, right? As price starts running back this way, they've most likely trailed their entry, meaning that they've put some sort of a stop in, some sort of a order in that's moving lower as price is moving lower, so that, hey, I don't know how far low it's gonna go, but I want to get paid off of me being right about this move. So I'm going to lock in some profits. I'm going to move my essentially my get me out of the order level down as price is moving down. And so when it reprices higher here, it's knocking some of those people out. Also, it's establishing down here below these lows liquidity, in a sense of any buyers in this area are going to have to initially stop loss here. So that level in which is to take them out of this transaction, right, is going to be down here. As it moves higher, they may be doing the same thing where they're moving their level that takes them out of the trade higher as price is moving higher, right? And so all within this movement, essentially liquidity is being engaged and is being engineered. And that's just this how I try to break it down and keep it simple for myself, so that eventually this can be something that's simplified and robotic, very mechanical, very much from a logical standpoint, like zero emotions, zero fear, zero greed, just data driven, systems for long-term profitability. That is my goal here, right? But now, next thing I want to talk about, if that made sense, hopefully, please leave, questions in the comment section if any of that first part was confusing. But now I want to move on to time frames, time intervals. And so as you can see here in this layout, typically you notice I'll have two different time frames. Usually the lower one will be on the left because I want more space, so I've given it more of a canvas. And then the right side will be a higher time frame. Doesn't need as much space because one of those candles on the right is typically several of the candles that are on the left. So each of these weekly interval candles is actually five of the daily interval candles. So that's kind of what I'm talking about. But so looking at the weekly as well, and one thing again, like I was mentioning this in the video where I reviewed this, actually, these equal lows down here. So in similar fashion, like I was talking about how prices engaging and engineering liquidity when it's moving around. So when it's dropped down here and it started to move sideways before right repricing higher here, that was part of this run below these lows here on the weekly, which in that same fashion, right? So when it dropped down here, whatever school of thought someone uses to describe what was going on and why it dropped here and then why it turned around, all I'm really thinking about is that hey, when it left here, any willing buyers were going to put stop losses below here. There were obviously going to be some that would trail the stop loss as prices running higher to lock in profits out of fear that it may reverse at any potential point. And so it's like if I'm getting paid by the market's movement, let me move my stop loss up as the market is moving up so that even if it does reverse on me, I've at least locked something in. And that is a very common thought process with traders. And that's another reason why the way that I look at the market from a liquidity standpoint makes a whole lot of sense. Because I've met a lot of traders, I've seen their trades and their ways of thinking and stuff like that, and it's for sure without a shadow of a doubt happening. And then there's people that don't use stop loss at all. And the problem with that, for example, let's say somebody saw before this candle turned back around bullish, it was looking like it was going to continue bearish at some point. It was very heavy candle. So there are people that also got into sales here, anticipating it running lower. When price whipped back above on them like this, if there was somebody that is not using the stop loss, they're in deep drawdown here. And I've been there before where I didn't use stop losses. They might even be looking at this inefficiency as, hey, this is resistance. So it worked its way into that inefficiency. I'm all good. I might even add another sell position here because now it's about to turn around. And then the opening of that next week, it did see some down movement. So maybe at this point they're excited because they're like, okay, cool, I was right. The inefficiency is the real resistance that I was waiting on. Now it's going to drop down, and I got my new entry in that's going to cover up for the losses that are in this one. Then when it gets back down there and this one's at break even, my new entry is going to be so deep in profit, and I'm still reaching for whatever target right they had for the downside. But as you can see, same thing here. Candle dropped down initially, then pushed higher, eventually closing above, right, this inefficiency. So now what could potentially have been in their mind is, oh man, I was wrong. I'm gonna close out now. This is hurting too much. I'm in such deep drawdown on these two positions right now. I'm about to lose my account if they haven't already. Right. So then the close here. And then the craziest thing is, right? So again, like the wick lower to close. And then the next week, that same thing, it drops lower and it's dropping down pretty aggressively. So at this point, if there were funds still in the account, it may have taken one more chance here getting in. Like, oh no, I'm not about to miss this move. Like I was in here, I re-entered here, I closed out here, and now it's all the way back down here. I can't believe it. Like, why? Like I guess this was the resistance, something up here, right? And so then to jump in again here for a sell, and then once again throttled, and at this point probably went full tilt, doing all type of crazy nonsense, and eventually, yeah, probably losing the account. And so the reason I say that, because I've been that guy, right? And these are the only reasons why I can explain it so vividly. Those examples, because I literally been that guy. And when I go back in hindsight and I look at the higher time frame, and I'm like, yo, like, how did I get tricked up? How did I, like, really read that wrong, right? And I'll get into that part specifically. There's a word for that, probabilities, which I will be getting to here. But just to finish this thought, I've been that guy before, and that's why I always start off on the higher time frame charts in my videos because I was counseled to do so early on in my journey, but I was also being shown how to take advantage of like 30-second, 1 minute, 2 minute, 3 minute, 5 minute opportunities in the market. And so it wasn't really connecting as far as like I wanted to be profitable, but I didn't want to have to do more than I guess needed to be done initially. So again, I was just super locked in on the smaller time frames, not really paying or giving much credit to the higher time frame until I got beat up enough that I realized, okay, the higher time frame is very useful. Even if I am just planning on being in a scalp and in a trade for just maybe a few minutes or even like less than an hour or something like that, it's still very beneficial to understand what the higher time frame is saying. And so I hope that that's been understood in my videos. With me always starting off monthly, weekly, daily. These are things that I preach now to anybody that talks to me about how I mark up the charts, monthly, weekly, daily, and even higher than the monthly. It definitely makes a lot of sense as well. As you can see, I got the 3 month up here, as one of my favorite time frames or time intervals. So definitely don't cheat yourself, I'd say, as I was cheating myself initially by not looking into the higher time frames. And so I already mentioned time. I'm gonna put the drawings back up. I already mentioned time and how it's the hardest part, but is also the most constant. So the one benefit of time is, as you can see here on the price axis, right, that these fluctuations up and down, and this is look at it from the weekly perspective, right? So these fluctuations up and down, number one, we know that the lowest technical, like positive or non-negative number is zero, and from zero to infinity essentially is that range of non-negative numbers, and then negative can also go down to infinity as well. But so as far as the price is concerned, it's really unlimited as far as from zero to infinity, like I said. And then looking at oil, oil actually was negative a couple of years ago, which I didn't even know. I still don't understand how that was possible, but it was a real thing. And for reference, you can Google it or look up the oil chart yourself. But yes, oil prices were negative for a time. So riddle me that, right? But so here on the weekly, like I said, just understanding from zero to infinity is the range as far as that price has the ability to fluctuate within. But as far as time is concerned, at least the way that men have broken it down, right, in the world that we live in today, there's a set amount of days in a year, right? A set amount of months in a year, a set amount of right weeks, or a set amount of days in a week, things like that, right? Like everything is constant, a set amount of hours per day, right? And so time is the constant in a sense of on a daily chart here, all of these daily candles start at the same time and close at the same time, with the exception of Sunday for a dollar. Sunday actually opens earlier than it does any other day throughout the week, but for most other assets, they open at the exact same time every day and close at the exact same time every day that they're open. And so the benefit that that gives me, and again, shout out to ICT, is he teaches about the importance of some of these time windows and the opportunities made available within them, and how to use past data to get the most high probability opportunity, like to be able to, scan for and identify the most high probability opportunity based on all of that data for reference. And so the next thing I want to talk about before I get into all of the assets and the levels and whatnot is, again, probabilities, right? So once the probabilities are established, I think that's the one thing for me that is still like a area of opportunity, because what I'm trying to help myself understand is that probability does not equate to certainty. It does not equate to guarantee. Like, for example, I like to reference and give examples concerning sports a lot. So, like a basketball player, for example, let's say like the best free throw shooter in the NBA. Let's say their free throw percentage is above 90%. Let's just even say it's at 95%. This person's free throw percentage for their career, right? So that means there's a 95% probability that they'll make their free throw when they make the shot, when they attempt the shot. So what that essentially says is that for 95 out of 100 attempts, can pretty much put my money down that they're going to win. And so if the odds for something like that, which is very likely, right, 95% out of 100%, 95 times out of 100 times, like that's very likely that's going to happen. Way more likely to happen than likely it won't happen. So let's just say that there was an opportunity on some app, and I'm not a financial advisor or anything like that. I don't recommend these things to you. I'm just giving an example. But if you watch sports, you've seen commercials about different sports betting apps and whatnot. So they're all over the fucking place now. But let's just say that the odds, for example, or the risk to reward ratio, in a sense, for that was, let's say it was even, it was 1 to 1, meaning that if I was to take a bet that this player would make their free throw, whatever amount that I put down on that bet, I would make that exact same amount back as my profit, right? So if I put down $1, I make $1, and I'd end up with $2, right? If I put $100 down, I make $100, I end up with 200, right? Like so, this is what I'm talking about as far as the example. And so, if that was the case, me personally, I feel like I'd be a fool with this understanding of this information and the understanding of the opportunity, right? I feel like I'd be a fool to not risk whatever amount every single time he takes a shot, because there's a 95% probability that it will go in. And so that's the side I want to be leaning towards, where I'm putting my money on that with the hope that, okay, I'll double it. Okay. And so that's what the importance of probabilities is. And then vice versa. If there was a player who their free throw percentage was 40%, so 40 out of 100, or 4 out of 10, or 2 out of 5, however you break that down, right? But 40% of the time, this person is going to make their shot, make their free throw attempt. So for this person, it'd make more sense for me to go against them, especially if the odds were the exact same, right? Whereas every dollar that I risk, I make one right back, right? Every 100 I risk, if I'm right, then I make 100 on top of that. And in the worst case scenario is I lose the initial risk that I put down, and that's how this works as well. And that's why what I'm saying is, what I want to help myself understand is the probabilities aspect of this. That there's no guarantees. There's really no 100% win rate. So losses are going to happen. Losses just need to be kept small and calculated, because over a large sample size of data, right, over those 100 free throws, over 100 trades, the probability will always show itself true at the end. But any sort of deviation from the plan that's created using data, right? Any deviation from that plan is catastrophic. It's self sabotage. And so that's the next part that I wanted to talk about, as far as following up with probabilities, with having a plan backed by data. And so I've come up with multiple plans throughout the years of this journey. And of course, every time I learn new information or I'm exposed to new data, there's opportunity to optimize any existing plans, or to just completely scrap them and create new ones. And so I've still yet to lock in on any one specific plan for what I would consider a long enough time to effectively implement it as part of who I am and what I do. And so I think that that is crucial as I do continue to develop and learn new things and collect more data. Uh, Finalizing a plan and then working that plan for, I'd say, a good 3 to 6 months consistently, day in, day out. I think that that's the next step, and I definitely see that being something that is accomplished here rather soon. And speaking of like the creation of said plan, as I talk through all these things right now, really just giving me some ideas. And so, of course, with this plan backed by data, I need to be focused right? Completely focused and 100% disciplined according to the rules of this plan, right? I believe that that just makes a lot of sense. Doesn't really need to be explained too much, right? The importance of being focused and being disciplined. And then all of this, last thing here before I get into the charts, is with the goal of developing a skill set to generate wealth by making money with the money. There are many ways in the world to do so, whereas, again, I was raised into a world where it was dollars per hour. That was kind of how the method of seeking value and or like understanding a person's value, right? I felt like that was where I was introduced to it. Was that, okay, how much money do they make per hour? And that's typically an exchange of, right, like my physical presence, being somewhere, doing something for somebody else's business, so that I can get a little cut on the back end of what the profits that they make for my efforts, along with the efforts of everybody else. Because of course, I haven't really worked for any small companies where it was just a handful of employees. A lot of employees, a lot of coworkers I've had, a lot of places I worked at. So definitely shout out to the business owners for doing their thing and growing a business where it needed so many hands on deck to be able to succeed, right? To be able to give people jobs and to help them feed their families and stuff like that. So again, not shitting on business owners, not shitting on people that work. It's all a part of this thing, this life that we live, this world that we're in. So it's all has a role to play. I just know that for me personally, I believed from a young age that I had the ability, or that I could acquire the ability to be my own boss. And so just for me personally, it may not relate to some of the listeners, but like that's just me, right? Like everyone's different, and so I'm just speaking my truth and my story from my perspective. That's all I can do. I don't want to make anybody else feel bad about their truth, their story, their perspective at all either. Again, I'm just sharing mine. And so but with that being said though, let's just get into the charts here, talk about some levels, and like I said, some thoughts, and then I'll put this up on YouTube and get to the rest of my day. But okay, so dollar chart. So as far as the month is concerned, because again, I'm trying to write monthly, weekly, daily, so I want to start with a monthly perspective. So, um, my monthly perspective initially was not anywhere near this. Would has played out, which is a very bearish month. Was actually looking to see the potential for some sort of bullishness. Um, but of course, what I did mention though before the week before last was that this breaker would be significant from the daily chart. Use that as resistance, right? Was able to slide down all the way into his monthly inefficiency, closing that week here, and then this past week a nice retracement back up into the range so far from high to low of the month. So as this last month, as the last week of the month is approaching, it will be opening up later on today. I'm really locked in on this 50% of the monthly range. So three things I really try to pay a lot of attention to, especially on the higher time frame, are going to be old highs and lows, which are pools of liquidity. It's going to be inefficiencies, which along this drop down there, lots of inefficiencies. As you can see, I don't have all of them identified and stretched out, right? But so old highs and lows is one, inefficiencies is two, and then the third is the midpoint of ranges. And lots of things can be considered a range, but in particular here, I'm talking about the monthly range from high to low, right? So that midpoint, as you can see where the zero point 0.5 is right below 101.594. So it's something just below that, right? Between 101.6 and 101.5. It's about that midpoint of the monthly range so far. So as far as some sort of a retracement, as the month was super bearish here starting out, and seeing the repricing higher here from this monthly inefficiency, right? Got real close to the low, then this repricing higher. Could be a retracement, could be reversal. Again, I'm not speaking about any sort of hardcore bias here. What I'm really just trying to bring attention to is how it makes the most sense for me to do my analysis and to use what I've already seen happen in price to get a feel for what is more likely to happen next, right? Using that probability mindset here again. So that's an area that I'm really interested in seeing if price shows me a willingness to get there. But of course, common sense, right? Before it can get to there, what are some other levels that could be in a way blocking it from getting there? Those are going to be the levels that are going to help me to really get a feel for if I can use them as some sort of a launch pad to, right, see them act as support once traded above to then, right, offer support to help get price up to this midpoint. And so, what are those levels? So, from the daily chart, the high of Friday is actually now the low of a weekly inefficiency. So the week before last, very bearish, as I mentioned, broke a lot of lows. So essentially, this week could just be a retracement of that impulsive move lower. And that is why, also, real quick, I'm not going to leave this up here, but I want to measure out this as well, right? And notice where this week actually closed at when it comes to the midpoint of the week prior. If you notice from high to low, and then where this candle opened, right, or at that close, it actually rallied up into the midpoint of the previous week's range, closed just above it, right? So again, this is why the midpoint of ranges is also an area that I really pay attention to because it can be significant as far as a magnet for price, especially during retracements. Probably the easiest target to have, in my opinion, rather than reaching for inefficiencies or highs and lows. Looking for the midpoint of any range, as price is already seeming to be doing a retracement. That's probably, yeah, literally probably the easiest target. And so again, these are things I'm getting ideas now in my head as I say these things out loud. And this is why it's good to be having a recording of it, so I can always go back and reference that I observed these things, I mentioned these things, and I can get those brain, those thoughts cooking up again, and hopefully develop some sort of a plan or a system, right, to be able to take advantage. But so just right was able to identify, okay, that this past week closed just above the 50% of the week before it. So as far as a weekly perspective is concerned, it's already retraced from the low back up into a premium, which is anything from high to low back above 50% is premium. Anything from low to high back below, right, 50% is discount. And so it's technically in a premium right now already. So if it was to start to roll over and drop back lower, I would not be surprised anymore now that I've seen, well, number one, it's already been very bearish. Number two, it retraced up above 50% of a range already that would be valid for it to then start to continue on lower. But also, the fact that there is now a new inefficiency created on the weekly chart with the close of this, it officially defined the parameters, the high and the low of that inefficiency from the weekly. All right, you see also how the midpoint identified. So any movement above Friday's high into this inefficiency can also itself, right, be a catalyst for then lower prices. Now this will all need to be confirmed on a smaller time frame, but the cool thing about the lower time intervals is simply that the data is able to be collected faster, right? Like for me to use anything from the daily chart or the weekly chart, I have to wait 24 hours for each individual daily candle, and I have to wait 5 days for each individual weekly candle to close. So it takes a lot longer for me to officially have that data collected, right? I still have to wait for the official closes. Like I said, it wasn't until Friday closed that I was able to identify this inefficiency here on a weekly. So now that it's identified officially, that's why now, okay, Friday's high is very significant. I'll be monitoring that, right? This high from the monthly inefficiency is very significant. It's a monthly level. Monthly levels will always be significant to me, especially the context of, right, price drop down into it through the midpoint, almost to the low, and it reaches right back up towards the high. So this could 100% just be right price digging into the range, retracing, finding resistance at the high end of it, and then slamming back lower and finally actually engaging the low end of it. So a likely scenario for sure. But again, as far as probabilities are concerned, I need still a little bit more information. And one way for me to get more information is with the opening later on today, right? So the price that it opens up for this new week is going to give me more information, as well as how that initial day prints. Typically, Monday trading isn't really too much going on. Usually just creates a little bit of a range, not too much of an expansion, really. And so that whole day will also give me some information for the following days, Tuesday, Wednesday, Thursday, and then Friday. And so as far as dollar is concerned, basically, right, any sensitivity and price action around here, right, at the high from Friday, which is 101.188, I'll be able to use that information with something like Euro USD, AUD USD, USD CAD, USD JPY, right? A lot of those forex pairs in which the dollar's movement is more heavily weighted as opposed to with the indices. I do use it every day for my indices analysis, but it's definitely way more influential over the forex markets, right? And I'll have more videos being able to showcase that, as I have been mostly focused on indices, but with forex moving the way it's been moving lately, I'll definitely make sure I put some forex videos up as well, because there's probably more of some other people's styles, to be honest. It costs less to play in the forex markets. I'd say that for sure. For especially for a new person that doesn't really know their way around, definitely cheaper to play there. But there are ways to play cheaper in the indices market. But again, not financial advice, right? Just speaking from my experience. But so okay, so there's the weekly inefficiency now above, and then the monthly inefficiency. So there's two levels to the upside as far as dollar is concerned, right? And then to the downside, yeah, there is low equal lows here, which could potentially be something. That's why I haven't deleted it just yet, because it's a weekly level, and it was a recent weekly level that was taken out right with just the week before last, and now it's right back above that low. So it could be significant in that viewpoint of like just random liquidity accumulated. The sell stop orders down here paired it with buy orders, and potentially is starting right a new leg higher. So again, that's why as far as probabilities are concerned, I don't really have one side or the other being more high probability, and that's what ICT defines as low probability. If I can frame a setup for both sides, or if I can't just frame a setup for one side, then that is considered low probability. And I agree, because my goal here isn't to gamble or to just take a transaction just to see what happens. My goal is to have enough data, right, backing my decision making process that confirms that it's higher probability of it doing the thing that I'm putting risk on it doing versus it doing the opposite. And in these markets, there really only essentially two things that are going to happen: is moving down or it's moving up. Now, there are four methods of delivery the ICT describes. There's expansion, there's retracement, there's consolidation, and then there's reversal. So those are four types of delivery. But essentially, all four of those types of delivery are doing one of two things: either the price is moving down, is moving up, or the third thing would be is moving up and down in a small range. and that's what would be considered consolidation. But that also is subjective to the time interval that's being looked at, because this could be looked at as consolidation on a weekly right here, but on a daily chart, what it looks like more so is it was moving down here, up here, and then down here, maybe some in between in there. But for the most part, the weekly chart is the only one that looks so tight. Is the whole point here. The daily chart is showing more up and down fluctuations because there's five daily candles per one weekly candle, right? And so then yeah, this inefficiency here on the daily, right, which was also confirmed with Friday closing. So Friday's closing confirmed two things. Confirmed a weekly inefficiency above, and then it confirmed a daily inefficiency below. So I'm essentially seeing that the dollar is potentially right in a situation where it may consolidate between these two levels unless it gives me some sort of a valid breakout signal, because I don't want to necessarily classify this as bullish, seeing how for the month so far been very bearish. I feel like it'd be foolish of me to try to pin this as bullish. It hasn't taken out any significant highs yet. The only significant high that really could take out literally is the one all the way up here. And so as it's moving higher, if it is going to eventually get up there, I also wouldn't be surprised if there's consolidations and choppy moves higher where there's like not really leaving many inefficiencies. The candles are overlapping like this, where this candle had the high here, but it closed down here. Then this candle pushes and closes above that one, and then the following day drops down to this wick, basically not allowing for any inefficiency, right? So very efficiently traded here, and then it expands higher, and then we finally get an inefficiency here. So what I would expect potentially, if it is to get up there, wouldn't be just like this where it just starts to spit higher, leaving large inefficiencies, even gap openings higher, right? As it's open with gaps lower on its way down. Also, I would anticipate it being a little bit more difficult of a push higher. But again, this is just from my experience. This is just me speaking hypothetically. How it actually plays out, it's very still open, right? As far as the potential for it to stretch, just like this stretch lower, it could stretch faster. It could happen in 2 3 days, right, where it goes and overtakes that high. That's just gonna depend on different catalysts with the news and what's going on in the world and stuff like that, right? But I believe that that's enough as far as dollar is concerned. As you can see from my chart, this is the exact same dollar chart that can be accessed by anyone using trading view. And so if you need to, right, take a second, screenshot these levels. Most of them, for the except for these trend lines here denoting the weekly inefficiency, and then like the rectangles, most of them have the exact price point over to the right, so that those levels, right, can be copied. But so that's the dollar. ES. So over here on ES daily chart is again going to be dependent on the movement with the dollar, right? So as the dollar is so far been bearish for the month, it may want to reach up into that midpoint. S&P still has room to go down to the 50%, and there's also a weekly inefficiency, which is that same thing. So once Friday closed, it confirmed this weekly inefficiency here from the two weeks before. So that also is an area where inside of this black line and this black line, I wouldn't be surprised if it gets down there and then it starts to run higher from there, because that's an area which I've seen, right, repeatedly, where it offers that type of setup. And then on the opposite end of that, if it digs into here, similar to how dollar dug into that monthly inefficiency, it digs into it, gets below the halfway point of it, I would then be expecting, right, potentially that repricing back to the high to slam down to the bottom, or repricing just back up to the midpoint of it and then continuation down to the bottom. So those are typically the two ways that I'm viewing that. Um, and so as far as S&P is concerned, though, right, not really in the business of trying to pick tops. So another area as far as just upside potential that I would be monitoring As on the dollar chart, of course, this brown shaded area, because on the upside there was an inefficiency that is now closed inside of and then closed below here. So could use this as resistance, right? So the brown box inside of around midpoint of that brown box, the halfway point of the daily wick here, and then above all of that, the halfway point is weekly wick. So as far as upside targets, if I'm seeing a lack of weakness and unwillingness to go lower, right, some sort of support being established, then to the upside, those are the two levels that I'd be very interested in taking profits out if I was to get into transactions. Like I said, with some sort of support, potentially this orange line here, which is the midpoint of a weekly level, right? Which is this weekly liquidity void, which keeps on getting stretched for whatever reason. But so that weekly liquidity void midpoint, as you can kind of see, right, it was resistance, resistance, broken, support. Couldn't quite get there this time, so could potentially be seeing something like that for this week, where it uses this as support and then rallies to, like I said, the midpoint of this daily wick, potentially to this closing price of this up close candle as a rejection block, or right, which is probably that probably lines up. I'm gonna do this for completeness sake, right, just to see. So okay. So yeah, the midpoint of this weekly wick is actually still below that closing price. So in order, right, the midpoint of the daily wick, the midpoint of the weekly wick, and then the closing price of this up close candle here on the day chart. So those three levels, I'd be very interested in securing some profit because there's a potential that those levels may act as resistance, especially if the dollar is bullish short term to end the month, just running up into the premium end of what's already been created as a range from high to low for the month of July. But so that's S&P on the weekly chart. So very, like I said, dependent on dollar, what I'm anticipating this to do, right? So higher dollar, then I'm looking at, right, this inefficiency here and the weekly inefficiency, and then ultimately, right, that 50% and how it responds there. Nasdaq or NQ, so monthly range so far, low to high. It actually got to that 50% this past week on Thursday and Friday. It engaged with that level. Still sitting inside of this daily inefficiency, and then with the close of Friday officially confirmed a new weekly inefficiency that could lend support, right? So the midpoint of that is also going to be crucial as well. And I guess can go ahead and apply that like that. All right, and so boom, now I got this all identified. So as far as continuation lower in Nasdaq, of course, this level is very important. The high, the weekly inefficiency, because it could just tap into it, right, and then continue higher, and it could tap into that without even dropping below the blue shaded area. So that's also another thing, is a confluence of a daily and a weekly support within the range from this black line to bottom of the blue. So not a very large range, but it could easily just drop down into that and then reverse higher, right? And so as far as downside, right, those are the levels I'm watching mainly, but also going to be keeping an eye on S&P because F is F if F if S&P makes an attempt to drop down to that 50%, showing weakness, Nasdaq may consolidate in here and may just right dig into and accumulate inside of here if it isn't willing to go any lower and they are just simply retracing to discount before another push higher, right? Because there's still unfinished business to the upside, and then shortly above that unfinished business would be new all-time highs across the board for the indices. But so that's Nasdaq. Also above the higher Friday is crucial because there's this daily inefficiency, right, that was also created to the downside as it dropped down here. So that's also something to keep in mind. It's a very large range though, and so I really just want to see first it makes some sort of attempt to get up back to this high, right? When it opens up for the week, and then I'll start to really lock in on these reference points. Of course, keeping the eye as well on the dollar. The dollar starts to turn back around, showing weakness before getting to that 50%. Then an idea like this, right? A working back inside this range, basically getting back above this high, and then it acting as support to allow it to get up to the midpoint of this inefficiency, and then essentially taking over the high, which is this candle's low, to potentially, right, same thing, maybe hit the midpoint of this wick or even take out the high and make a new high for the month. All likely scenarios. There's a very, very volatile market driver coming in this week by way of the interest rate decision. So I'm just, keeping those things in mind, right? And so that's Nasdaq, and then Dow Jones. So Dow Jones, I had measured out the weekly range. ICT also teaches something called it's called TGIF. Thank God it's Friday set up. Where essentially if the market has been just one sided for the week on Friday, there may be an attempt to drop down into 20 to 30% of the weekly range is a retracement. And so 30 actually did that perfectly on Friday, essentially creating a low just below that 20% retracement of the week. But as far as you can see, very bullish for US 30 for the month, right? From low to high. That 50% is way down here. And also, as far as that weekly range measured out, right? So then this is the 50% of that weekly range of this past week. So that would be my first area that I'd be really focused on is some sort of a 50% retracement of that range. And then if it starts to still continue weakness through there and also is not able to find support at any of these yellow lines, I know it's not a very large range from there, but it is a good 100 points from that lowest yellow line down to this 50%. Because if all of that gives way, then I will really have no doubt in my mind it may be reaching for the 50% retracement of the month. And not really anything else that can be utilized for 30. There's this small inefficiency here on the daily chart. So this candle's high is 173, this low is 192, so like almost a 20-point range there. Gold. So I did say I was bullish gold. Want to see it push towards the 2000s. So it did make a nice push higher last week, but then also did retrace right back down pretty much near the opening price of the week. There's a lot of areas in here as far as, okay, I was looking at the midpoint of this, broke through that, right? Short-term support there, but then got back below and then acted as resistance, but still going to get rid of it because there's other reference points in here, right? So this flip zone here on the daily chart, which once it was able to break up to the high end of it, right, drop down to the bottom inside of this other inefficiency, a nice rally from there, right, getting back above the June opening, worked that level a couple of times before dropping back down. As you can see here, that monthly range is also identified, so 50% is actually, it would be a dropping down into this weekly inefficiency here. So that could be an option for gold, drop it down into there before continuing higher to the 2000s. And I would talk about other assets. I'm just gonna show them really quick though, because it's the same thought process, right? I pretty much broke down where I'm coming from about a lot of these topics, so it's the same thought process across the board on with all of this stuff. So I just scan through it, and so the markups can be seen. The data feed is forex.com for all these assets. So similar thing, all those levels for the most part are identified on the right hand side, so they can be copied. Um, and utilized by any of my viewers. So I'm gonna end it there though with UJ, which is USD CAD, and it on UJ. And shout out to the believers, shout out to the homies that inspire me to be better each and every day. I love you, I appreciate you more than you ever know. I will catch y'all in the next one. Take care, peace.